All right, so now we got Karen and Ken, and they're going to take Social Security at 62 earlier. So remember, Karen is a little bit younger than Ken. So when she starts pulling it, that's when Ken can start taking his spousal benefit off of her benefit base. So what's it going to look like now? Let's dive into this. It's pretty interesting, actually. And this is the estimated effective tax rate. And you see, because they're taking Social Security early, and Social Security is basically giving them enough plus the amount they're taking from their required distribution, not required distributions, but their distributions from their 401k, in this case, an IRA for Karen. They basically have no tax. And the reason for that is because they have enough standard deductions to make sure there's no taxation. So let's tell you what I mean by that. We'll just go to I think it's distributions. No, it's the details. Let's go to right here. Sweet. So in 2020, you can see they have 53,000 coming from their. Actually, let's go to 2021, because they're 62. That's right. She's not 62 yet. 2022. There we go. All right. So in 2022, you'll see they have 17,000 coming from their IRA. Why they only have that? Well, because they have 35,000 in Social Security benefits. All right, so 35,000 in Social Security benefits means only 1,700 is taxable. Not going to give the provisional income, how we figured that out here, but just remember, married filing jointly, the first, how much of their money is not subject to taxation of their Social Security benefit is 0 to, was it 32? Is nothing. So any of their provisional income between 0 and 32, none of it is subject to taxation. And again, how you figure it out, you take half this amount here, which is the amount they had coming from their IRA, plus half of this amount here, which basically means hardly anything is subject to taxation, if that makes sense. So we have 17,000 from their IRA, 35,000 from Social Security. That gives them the amount they need to live on, and then only 1,700 of that, though, from their Social Security is subject to income tax. So 17,000 IRA distributions plus 1,700 means their adjusted gross income is $19,000, but because their standard deduction is $27,000, no tax at all. So that's a pretty good place to be. All right. So let's go where we want to go here. Let's go back to estimate. Now what happens here, though, is we hit, let's see, age 74 for old Karen. So let's go to age 74. I can't tell what year that is. We're going to go to age 74. We'll just go forward, I don't know, 14 years or so. Let's go to 2036. All right, so now, standard deduction. Yeah, so now Karen is single. So now Karen's a widow. All right, so here she has qualified dividends because she's taken so much out of her IRA because of RMDs. She had to reinvest it, and she'll pay tax on that a little bit. But here, taxable amount $97,000, of which she's getting IRA distributions of $97,000 because of RMDs. She has $30,000 of Social Security benefits. Remember, she's losing Ken's half. All right, Ken's not really half, but Ken has Ken's benefit is half of Karen's Social Security benefit, if that makes sense. Now, so Karen's full retirement age, or PIA benefit, was $2,250. Ken's going to get half of that because he took that benefit at his full retirement age. Confusing as all can be, I get it, but that's roughly $1,125 a month. Basically $13,000 a year. That money's gone. So now Karen's Social Security is $30,000, but 85% of that is subject to taxation simply because she has all this money coming from her RMDs. $97,000 from required minimum distributions, plus the amount she needs to live on. So that's a significant tax hit to her because her IRA is so big, and now she's a single taxpayer, that she has big distributions coming from her IRA, which makes her Social Security that much more taxable. In this case, her income is $130,000. Her standard deduction, and this says qualified business income, it's just itemized deductions, personal exemptions. Those will come back. So essentially, what we're doing here is they haven't updated the new tax forms to revert back to the old tax form. So we're just saying it's QBI, it's not QBI, it's personal exemptions. All right, this is what this is. So she has $11,000 of qualified standard deduction, plus $16,000 of personal exemption, or $6,000 of personal exemption, which means her AGI is $130, her taxable income is $113. Her federal taxes are $21,000. I hope that makes sense, because I get this lot. What shows qualified business income? What does that mean? Man, it just means that it's a personal exemption. They haven't changed it because we got to go back until the old tax forms in 2026, and they just haven't updated it yet because we don't know where it's going to be. We don't know what the tax is going to be. Take advantage of it now. All right, so if we go back to estimate here, let's go to retirement. I'll show you what I'm talking about, and we're going to go to cash flows. Taxes. All right, so no taxes here. No taxes. That's the time she should be doing some serious Roth conversions. No. But then all of a sudden out of nowhere in 2020, let's see, 2029, when the RMDs kick in, the taxes go from $0 to $10,000. You know, she has state of California is $1,000. And then watch this. We go 2037. Then look at that, $11,000 in Fed taxes, $1,500 in Fed tax, and all of a sudden out of nowhere, a 50%, I mean, even more than that. I mean, we're talking a 66% increase in taxes from 2032 to 2033. Well, let's take a look at the income though. So 2032 to 2033, that's basically a 66% increase in taxes. 2032 to 2033. This is 2032, 2033. Look at the income, total income right there. It drops from 121 to 108. 66% increase in taxes and a $13,000 decrease in income. How's that? I mean, literally, that's just a widow's tax trap, man. You know, we got a roughly 10 to 15% decrease in income, which coincides with a 66% increase in taxes. Horrific. All right, so let's look at the spreadsheet and see what we're looking at here. So this is no planning. We haven't done any Roth conversions or anything. We're just taking Social Security at 62. So we got here, you can see there's Social Security 34,000, 35. And then Ken dies, so she went from 45,000 to 27,000 with Ken dying from Social Security. Remember, she took hers early, so she had a reduced benefit. Ken took his spousal benefit at full retirement age. Thus, his spousal benefit was not reduced. So there's a less of a gap between Karen and Ken's benefit, even though half of his spousal benefit would reflect it should be half of her benefit, but it's not half of her benefit if she took her benefit early. I hope that makes sense. So because of this, you might be saying, wait a second, 27,000 is her benefit, 18,000 is Ken's benefit. That's not half of her spousal benefit. No, it's more than half her spousal benefit because her benefit was reduced. Her spousal benefit is still half of what her PIA is, or his spousal benefit was still half what her PIA is, but because she took it early at 62, her benefit was reduced, but Ken's benefit is not reduced because he took it as full retirement age. I tell you, a lot of people make that mistake. They say, oh, it's going to be half of her benefit. Yes, but it's going to be half of her benefit depending on when he takes it. And if he takes it earlier, it would be reduced as well, but because he took it at full retirement age, it's not. I know there's a lot to chomp on. But anyway, so her benefit is still, that's her full benefit, which is she loses $18,000 a year because Ken's gone. So her Social Security drops from 45,000 to 27,000. But now look at these planned distributions. These are RMDs, man. I mean, they're just through the roof. So she has $108,000 of income. Where before she had 121. All right, so her income dropped, but her taxes, her expenses are only 62,000. Ken's gone, so she only has expenses of 62,000, but 20,000 of that is taxes. So her total outflows are $83,000 because a quarter of that is going to pay the tax man. Nuts. So if we come down here, she totally pays $770,000 in taxes when she takes her Social Security at 62. She has total outflows of $2.96 million, which means net of taxes, she had total essentially spending power of $2.138 million. If we go back to Social Security, when she took Social Security at 70, oh wait, did I do this correctly? It can't be the same, is it? Yeah, exact same. Wow. So wait, did I do that correctly? She had $2.916 million of spending, $770,000 of taxes. If we go back here, she has $2.74 million of spending, $648,000 of taxes. Wow, the exact same amount of net spending power, 2.138749. I just want to make sure I did that. Where's my thing here? Let's just make sure that is correct. Equals this minus that equals, yeah, there it is, man. Nuts. So they both have 2.138 million of total spending power. When she took it at 66, she had 2.3 million of total spending power. So, I mean, you're thinking, 66 might be the better way to go, but let's take a look at total IRA accounts. So in here, total IRA, she has, this is 1.98 in traditional IRA, 1.7 in taxable accounts, 3.749 is her total liquid net worth, 3.749 at 62, taking Social Security at 62. Taking Social Security at 70, she had 3.28 million in total liquid net worth, of which 1.4 was IRA. So here, 3.749, of which 1.9 is IRA, and then at 66, she has total 3.47, of which 1.7 is IRA. Well, we'll do a conclusion to wrap all this up to see which one looks better at the end. But at the end of the day, it's almost a wash when to take Social Security at 62, at 66, or at 70 in terms of how much is left over. But in terms of taxes, without question, if she took it at 66, she paid 708,000 taxes. If she took it at 70, she paid 646,000 taxes. If she took it at 62, she paid $77,000 of tax. So taking it at 70 from a tax perspective is without question the better way to go. All right, stay tuned. We're going to start running some numbers when we start doing Roth conversions. And then finally, we'll have a wrap up to show you what looks better to me. All right, thanks.